Okay, Assalamualaikum warahmatullahi wabarakatuh. Um, so I will continue on this lecture about ratio analysis. All right. Firstly, we have actually covered about the financial statement. We have already covered about the income statement, about the balance sheet, and statement of cash flow. And now we like to see uh, the condition of the company by using some simple analysis. And I will also be showing you on the what call it how we actually like to evaluate or assess the financial statement of a company that is listed in the stock market in Malaysia. Okay, I'll give one example of a company that is uh, has just released its quarter report recently. Probably I'll show it to you uh, about how we are going to read the financial statement. All right, now let's continue on with the ratio analysis. All right. So basically, the ratio analysis is actually one of the tools that is used by financial managers, by also the investors to assess the financial condition of the firm. Now, we evaluate the relationship between financial statement variables. Now, it is used also to compare current performance with the past performance to evaluate the impact of any financial decision implemented. So we call it this is as internal analysis. And also we can compare the current performance within the industry to evaluate the standing of a particular firm to the ratios of the industry average. Now, ratio can be categorized into four main categories as follows. For example, the first one is liquidity, the second one is efficiency, and the third one is financial leverage, and profitability is the fourth one. Now, for example, I'll give you an what we call it financial statement of Kayu Kayan Berhad. This is actually um, a hypothetical financial statement, right? Now, this is what we call it income statement for the year ended 31st December 2017, supposedly, right? So basically, if you look at here, so we have the net sales, okay, which is 700,000 ringgit. Then we have to minus with the cost of goods sold, which is 500,000 ringgit. Then we have a gross profit of 200,000 ringgit. So this gross profit, okay, we have to deduct with all the expenses from selling expenses, general and administrative expenses, okay, totaling of 130,000 ringgit. So our earning before interest and taxes or EBIT is actually 70,000. So 200,000 minus 130,000, you get 70,000. And after you get your EBIT, so you have to deduct the interest. Okay, you deduct the interest first, then you deduct the tax, the T. So the interest expenses is actually 10,000. So 70,000 deduct with 10,000, then you'll get 60,000, which is we call it earning before taxes, which is not yet being minusing the tax. So the income tax, for example, here we use 27%. These figures can actually varies accordingly to the tax rate that imposed by the government. So with an income tax of 27%, it will actually equal about 16,200. So how do you get 16,200? Is you take the 60,000, you multiply with 0.27, then you get 16,200 ringgit. So your net income is 43,800 ringgit. And the next one, we will look at the balance sheet for Kayu Kayan Berhad as at 31st December 2017. So basically, we have the asset portion here. So the asset consists of the current asset and also the fixed asset, as mentioned before in our previous class. So in the current asset, we have cash, marketable securities, account receivable, and inventory. So these are all the examples of the current asset of a company. So basically, it's actually liquid, which can be converted to cash within 1 year. So basically, we have cash about 17,000, then marketable securities of 7,200 ringgit, and also account receivable, which is the your customers who have actually um, we call it purchase your product in credit, so it's a totaling of 30,000, and also inventory 93,000 ringgit. So the total current asset here, if we add all of these current asset, it will total about 155,200 ringgit. And then we look at the fixed asset. The fixed asset is the net plant and equipment, which is 290,000 ringgit. So the net plant and equipment is actually your fixed asset minus your depreciation. So we call it net plant. So depreciation is actually being deducted from the plant and equipment, right? So the depreciation is 29,000 ringgit. So your net fixed asset is actually 261,000, which is 290,000 minus with 29,000, you get 261,000 ringgit. So this 261,000 ringgit, you add with your current asset 155,200 ringgit. So your total asset will total to 416 ringgit. That's 416,200 ringgit. And the next one would be the liability and the shareholders' equity. So as I mentioned before, your total asset must equal with your total liabilities plus with the shareholders' equity. So in liabilities, we can actually further divide it into current liabilities and also the long-term debt. So basically, the current liabilities is consists of account payable of 55,000 and also notes payable of 13,000 ringgit. So your total current liabilities is 68,000 ringgit. So so in your we call it liabilities, you have also your long-term debt, which is totaling about 100,000 ringgit. So here we also have to add with our owner's equity, which is the common stock and also the retained earning. So the common stock is 200,000 ringgit, and the retained earning is about 48,000 ringgit and 200. 48,200 ringgit. So your total owner's equity is actually 248,200 ringgit. So you add this with your long-term debt and also your current liabilities, you will have a total amount of the total liabilities and owner's equity of 416,200 ringgit. So if you look at this figure and compare it with the total asset, see this is total asset. So the total asset also have the same amount, total figure, which is tally to the liabilities and owner's equity, which is 416,200. So this is normally a balance sheet will have a balance figure between assets and also liability. So here, if we want to do the what you call it the ratio analysis, then we have to calculate for all four categories of ratio that I've mentioned before, which are liquidity, efficiency, leverage, and also profitability. So how you are going to calculate here? There is a certain formulas that we have to use that probably we have to memorize it, and also we have to understand what is actually that ratio means, okay, for the performance of the company. So for example, if you look at liquidity ratio, the first ratio here is current ratio. The formula is current assets, then you divide by current liabilities. So we refer back to our balance sheet. So this is you have to look at the balance sheet. So this balance sheet, you find your total current assets here, which is 155,200 ringgit. Then you have to divide with current liabilities, so which is 68,000. So here you get 155,200 ringgit. You divide by 68,000, then your current ratio is 2.28. So which means that your current asset is twice greater than your current liabilities. And then you compare it with the industry average. Industry is about 3. So basically, the industry have a 3 current 3 uh, out of one current liabilities. So if you compare this with the industry, the company is actually performing below the industry average. So what is actually the best ratio here? So basically, as a rule of thumb, probably it's better to have a bigger current ratio, is more than one, because it's actually stating that you have enough current asset to cover your current liabilities. So basically, that is about current uh, ratio. And the current ratio is also stating implying that whenever you have a lesser than one current ratio, stating that probably the company cannot be able to meet its short-term obligation. So whenever the bills or the current the liabilities comes due, then the company cannot pay, cannot serve its short-term obligation. So that is the problem if the company have a lower than one of current ratio. And also, if we look at the next one, we have another liquidity ratio, which we call it the quick ratio. Now, the formula is almost the same as current ratio just now, except that we have to minus inventories from the current asset. Why we need to minus inventories? Because in inventories is the least convertible current asset in the current asset, because inventories normally it actually refers to is either raw material or work in progress or finished good. So basically, the raw material and also the work in progress cannot be converted to cash in a very short time unless it is already finished as a finished good. And the same thing as finished good, you want to convert it to cash, you have to sell it first. So that's why if you want to have like a better ratio, liquidity ratio, you minus with inventories. So here we look at the current asset, which is 155,200, and then we refer back to our balance sheet. So the balance sheet inventory is actually 93,000. So you have to deduct 93,000 from your current asset, then you divide by the current liabilities, then you get 0.91 ratio of quick ratio, whereas we compare it with the industry average, which is 1.5. So basically here is actually showing us that the company is actually having some problem of its liquidity ratio. So if all the current liabilities are being due, then probably the company cannot meet its short-term obligation. So that is for liquidity ratio. And then we look at the next ratio, which is the efficiency ratio. The efficiency ratio we have firstly is the inventory turnover. So how our we call it inventory is been turned over based on the cost of goods sold. So the formula is the cost of goods sold divided by inventory. So the cost of goods sold, if we refer back to the income statement, so you have to refer back to the income statement, it is 500,000. So here 500,000 you divide by 93,000, which is the inventory, then you will get 5.37. The industry average is 6.5. So basically 5.37 means that you have to make purchase about 5 times in a year. So this is actually depending on the nature of the company. If the company is actually we call it company that sell uh, fresh fish, then the inventory turnover might be higher. It might be 365 because you purchase your we call it your raw materials frequently. So it depends on the industry itself, whether you are in industry which has we call it a higher inventory turnover or lower inventory turnover. But if you compare this, okay, the company is actually having a lower turnover as compared to the industry average of 6.5. The next one is the average collection period. So how many days that you need to collect your account receivable in a year. So basically, the formula is account receivable you divide that by the daily credit sales. So for example, here the account receivable is 38,000. Then you divide by the credit sales. So in this particular example, we take the credit sales from the net sales. So probably this all of these are all credit sales. So here, the uh, the credit sale is 700,000. Then you divide by 360 days. Okay, so we got 19.55 days. Industry average is 15 days. Then this company is actually having problem of collecting their account receivable from their customers. So basically, the lower the numbers of days is better for the company's cash flow. However, if we have a very low, we call it average collection period, probably we will have lower sales. So it's actually depending on the industry itself. So if the industry is 15 days, so we should try to to reduce the number of days here, 19.55 to 15 days. The next efficiency ratio is the fixed asset turnover. So basically, the fixed asset turnover is stating that how good or how efficient your fixed asset being generating your sales. So the formula is you take the net sales, you divide by fixed asset. The net sales, as we refer to the income statement, it is 700,000 ringgit. Then you look at your fixed asset. This is actually can be retrieved for your balance sheet. So your balance sheet here, the big asset is 261,000. So the we call it the fixed asset turnover here is 2.68. So if compared with the industry average is 2.8, so basically your fixed asset is not really efficient as compared to the industry average. So probably you have to increase the sales to increase the fixed asset turnover, or you have to reduce the fixed assets. And the next efficiency ratio is the total asset turnover. Now you are looking at your total asset is, instead of your fixed asset. So a total asset is actually we call it a combination of the fixed asset plus with the current asset. So here the total sales is 700,000. Then you divide by 416,200 ringgit. Then you get 1.68. So basically, your every 1 ringgit asset spent in your assets will generate 1 ringgit of 68 cents. So industry average is 1.5. So here you are actually better than the industry average because you have 1 ringgit and 68 cent generated for every ringgit that you spend for your total assets. And the next, we call it a ratio, okay, which is the financial leverage ratio. Now we have the debt ratio, which is the total debt divided by total asset. So you take the total debt, which is can be retrieved from your balance sheet, and then you divide by the total asset, which is also from the balance sheet. So here you have a 0.4, we call it debt ratio. So this number, we don't want this number to be too high, for example, 0.7 and above, because if you have a debt ratio which is 0.7 and 0.8, it's actually a signal that the company is actually having higher higher risk in terms of financial leverage. So when it's the risk is higher in terms of debt risk, so basically it can trigger that the company can face we call it legal action and also bankruptcy action. So if you compare with the industry average, industry is only 0.3. Probably here we need to reduce our total debts or to increase our total asset so that we can have a better figure and comparable with the industry average. The next one is time interest earned. Time interest earned is actually how much is your earning before interest and tax can cover your annual interest expenses. The higher the time interest earned is better. For example, here the earning before interest and tax is 70,000. This can be retrieved from your income statement, and then your annual interest expense also can be retrieved from your income statement. So this is we have 7 times of we call it time interest earned. So the industry average is 7.5 times, which means that the industry having a higher earning before interest and tax, or a lower annual interest expenses. For the next ratio, we have the profitability ratio. So this profitability ratio is actually the net profit. We have the first one is the net profit margin. The net profit margin is simply stating that the company is actually getting about 6.26% net profit margin. So the formula is net income, you divide by sales, then you multiply with 100%. So from the net income, you can retrieve from the income statement, and the net sales also can be retrieved from the income statement. So here we get 6.26, but the industry is actually 7. So basically, it's almost uh, comparable with the industry. But if we can increase it to more than 7%, then the company is better off than the industry. And then we look at the return on assets. The return on asset is actually net income divided by total asset. Then you get here about 10%. Now, this is actually stating that so from every ringgit that you spend on your total asset will actually generate about 10% income from your total asset. So the industry average is 10.5, which is greater than the company. So probably the company need to increase its return on asset so that it can be uh, the same or better than the industry average. And then we look at the return on equity. It's actually simply how much return that the shareholders can get if they invest in the company. For example, here the formula is net income divided by owner's equity. So the net income is 43,800. Then you divide by the owner's equity. This can be retrieved from the balance sheet. So we get at about 18% return for every ringgit that we invest in the company. We'll get about 18% return, so about 18 cents. So here, the industry average is 15%. So from this figure, we know that this company actually can attract more investors to invest to the company. So summary here, we have liquidity ratio, we can use current ratio, we can use quick ratio. For the efficiency ratio, we have inventory turnover, average collection period, fixed asset turnover, total asset turnover, and the financial leverage ratio, we have debt ratio, the time interest earned, and also profitability ratio, we have net profit margin, return on asset, and also return on equity. Okay, the list is not exhaustive. You can actually, if you refer to other uh, ratios that are being used in the market right now, there are probably more ratios that we can actually look into. For example, in the stock market, you might want to look at the PE ratio, was the price, which is the price earning ratio, and also the dividend yield. The dividend uh, yield is actually saying that how much that the what call it the shareholders can actually gain dividend from investing with the company. Okay, but however, there are some limitation of ratio analysis. Comparison with the industry average is difficult for firms with very kind of industries, and different operating and accounting practices among firms make comparison difficult, and seasonal factors may distort ratios. So, in summary, that in this chapter we have discussed the importance of accounting and financial statement to a company, and also discuss how to evaluate the performance of the firm using ratio analysis. Also discuss the limitation of ratio analysis. So in I will not I will finish this lecture here, but there is another video that I'm going to make. It's actually how you want to look, how you want to refer to assess the what you call it a real company in the stock market, and you want to assess the financial condition or the fundamental analysis of the firm. I will actually uh, provide the what you call it, explanation in the next video. So with that, thank you. Assalamu alaikum warahmatullahi wabarakatuh. And thank you.